Welcome to Financial Insights in Minutes. Today we're tackling urgent predictions about market corrections and what that means for your investments.
We'll explore expert insights from leaders like Lance Roberts and Jake Boyle. Prepare to be informed quickly.
What is the Fed likely to do? David Rosenberg shares concerning data from our latest job report. Don't miss it.
If Bitcoin rallies post-election, what price predictions are on the horizon? Jake Boyle has some powerful forecasts.
Let's dive straight into the first segment, discussing market corrections with Lance Roberts. Let's dive right into today's discussion about the market correction everyone has been anticipating.
Indeed, we're unpacking the first signs of the correction and what investors should be watching for.
So, what's the main thesis of this week's discussion?
Lance emphasizes that the correction has officially started, and we need to analyze how deep it might go and where potential buying opportunities lie.
What was the scoop on the job market data?
Job indicators are showing troubling signs, as the latest revisions indicate conditions aren't as rosy as projected.
What are traders feeling in this climate?
Traders are becoming increasingly anxious, with sentiment changes potentially leading to more significant market movements.
And what about technical analysis?
The current conditions show a broken trend, implying potential downturns ahead, adding to investor uncertainty.
What should investors consider during these corrections?
Investors could see attractive buying opportunities as corrections occur, especially with long-term growth stocks.
What predictions are being made about market corrections ahead?
We've got to brace for potential further corrections, driven by ongoing political and economic uncertainty affecting trader psychology.
So, what's the key takeaway here regarding these corrections?
Investors must adapt to the current trends and approach with a strategic mind, keeping a lookout for opportunities in the midst of uncertainty.
How can investors maintain their composure during challenging market times?
By focusing on long-term goals and eking out the noise of daily market fluctuations, investors can navigate volatility more successfully.
Let's dive right in. Today's focus, the market's recent turmoil and what it means for investors. Tom Lee from Fundstrat Global Advisors joins us to break it down.
Absolutely. Tom's deep industry insights make his views critical in understanding these market fluctuations. Will the Fed's actions make waves in our financial waters? Let's find out.
What's the key takeaway from Tom's analysis?
The core thesis here is clear. With the job market softening and recession indicators flashing, the Fed may soon need to cut rates. But are we truly on the verge of a market wreck?
Now let's discuss those ominous job numbers. What's the scoop?
Softening job numbers highlight a dip, especially in manufacturing and retail. Interestingly, health services and education are the saving grace.
What's the market saying about the Fed cuts?
The buzz is around possible cuts of up to 50 basis points. That's signaling panic among traders, reflecting a need for economic support.
And what about the yield curve inversion?
It's officially been inverted for over 700 days, a strong historical indicator that warns us a recession could be coming in less than a year.
What sectors should investors keep an eye on?
Investors are flocking to utility stocks and gold. They're like the life jackets in this turbulent ocean of volatility.
Lastly, what's Tom's take on what's next?
Historically, September is rough, but with historical optimism returning in the fourth quarter, we could ride out this wave to calmer seas ahead.
Now, what does Tom predict for the recession timeline?
He predicts a market bottoming out in response to these indicators, potentially paving the way for a thoughtful recovery as confidence jumps back.
And what about a possible bullish fourth quarter?
Absolutely. Historically, October has been a strong month, leading investors towards undervalued opportunities in the market.
Wrapping it all up, what should investors keep in mind?
In these turbulent waters, investors must stay strategic. With market signals shifting, staying informed and adaptable is crucial. More insights coming up in the next segment.
So, where does the Bitcoin market stand after recent Fed discussions? Let's dive right in. Our guest today is Jake Boyle, the Chief Commercial Officer of Caleb & Brown, who made quite a splash by predicting Bitcoin's pullback to the $50,000 mark. Welcome back, Jake.
Thanks for having me. Always a pleasure to discuss the currents affecting crypto markets.
What is the core thesis of today's discussion?
The Fed's anticipated rate cuts are set to influence Bitcoin dynamics. Historically, Rate cuts have triggered market rallies, but the underlying economic uncertainty creates a paradox, especially for risk assets like Bitcoin.
What are the key points regarding how the market reacts to Fed rate cuts?
Well, there's around a 65% chance of a 25 basis point cut. Following this, we could see Bitcoin rallying to around $65,000 to $70,000 in a typical buy the rumor, sell the news pattern.
How about Bitcoin's relationship with the stock market?
It's fascinating. Bitcoin has shown a strong correlation with the NASDAQ and small caps, indicating that traditional market dynamics are still a significant driver for Bitcoin values.
What can we expect in the future for Bitcoin, considering current events?
If the political tides turn in favor of Bitcoin advocates like Trump, we might very well see Bitcoin hitting that magic $100,000 mark before the year's end.
What about the possibility of the U.S. adopting a Bitcoin reserve? What's the forecast?
That could drastically increase Bitcoin's price, but it also raises concerns about its core decentralized values. It's a double-edged sword.
That brings us to our concluding thoughts. What's the final takeaway?
As the landscape shifts with potential Fed cuts and looming elections, Bitcoin appears to be at a crossroads. Are we ready for the ride ahead?
And let's consider how political events might sway Bitcoin's trajectory. What are your thoughts?
With such fluctuations poised on the horizon, it's clear that anyone keeping an eye on Bitcoin has much to consider.
Let's dive right in. So what's causing these ripples in the job market this August?
Today's discussion centers on the recent U.S. jobs report, revealing only 142,000 jobs added, shocking economists expecting more. With cracks appearing in the labor market, we turn to the insights of an expert, David Rosenberg, who never sugarcoats his analysis.
What's the main takeaway from Rosenberg's analysis?
Rosenberg argues that the Fed's policies are failing to address deeper structural issues in the labor market, leading to concerns of a potential recession.
Can you shed more light on this weak job growth?
The report's 142,000 jobs added suggest the economy may not be heating up as hoped. Plus, downward revisions from prior months indicate a trend rather than a one-off situation.
And what about underemployment trends?
We're seeing underemployment rise to 7.9%, an indicator of more serious issues in the job market, especially for those who want full-time positions but can't find them.
How is the Fed reacting to these signs?
There's chatter about the Fed possibly cutting rates by 50 basis points. Critics, including Rosenberg, argue that the Fed's responses lag behind current economic realities where faster action is warranted.
What does this mean for consumer spending?
The trends show a definite shift towards non-discretionary spending. As consumers tighten their belts, it suggests potential recessionary signals ahead.
What are Rosenberg's predictions for the future?
He predicts if the Fed doesn't act decisively, we could be facing a recession by 2026. The need for action is critical to avert this.
Looking into the crystal ball, what does the future hold?
Rosenberg foresees that continued job market weakness could lead to a recession very soon. Layoffs could surge into late 2024, shaping a cautionary landscape.
And what about the market's reaction to potential rate cuts?
Rate cuts might soothe investor worries, but the deeper economic issues could keep investors on edge. It's a delicate balancing act for the Fed.
So what are the big takeaways we should consider?
The clock is ticking. The Fed needs to act swiftly to address these economic slowdowns or risk plunging the economy deeper into recession. A proactive approach could pave the pathway to recovery.
And how about the global aspect of these economies?
Absolutely. The Fed must recognize the interconnectedness of global markets. U.S. policy is vital, but external factors will influence the outcome for the economy.
As we ponder these economic currents, what's your take on the Fed's next steps?
We want to hear from you. Share your thoughts in the comments below about how you think the Fed should navigate these waters.
Today, we dive into a crucial topic: the Federal Reserve's response amid signs of labor market weakness after the latest non-farm payroll report.
Yes, Tyler and Quinn break down the key insights from recent employment data, revealing what it means for future Fed actions. Spoiler alert, the economy is pulling some surprises.
What's the central takeaway from Tyler and Quinn's discussions? Could the Fed's easing measures be imminent?
Absolutely. The latest data shows non-farm payrolls grew by only 142,000, which is below expectations. This, combined with a drop in the unemployment rate, raises eyebrows on economic strength.
What do the NFP numbers reveal about our labor market?
Despite the lower job growth, a decline in unemployment suggests strength. However, it's crucial to recognize the rising U6 unemployment, meaning there's more beneath the surface.
So, what's the buzz around the Fed's next steps?
With these labor market indicators, traders are betting on a significant easing. If the numbers trend downwards, we could expect swift action from the Fed.
What are the broader implications of this labor market data?
Tyler hints at a worrying trend of temporary job losses, which could become permanent if economic conditions don't improve. The implications here can affect overall recovery.
Tyler, what do the future forecasts look like based on these trends?
Expectations are grim. Rising unemployment could taper the economic recovery. If companies continue to cut back on jobs, we might see a worrying trend toward more part-time employment.
What about the implications of Fed decisions?
Well, the clarity of the Fed's stance will significantly impact market sentiment. Major changes could unlock new economic pathways, yet there's uncertainty when it comes to potential outcomes.
As we wrap things up, what do we need to take away from today?
The Fed's impending decisions will be crucial in managing the labor market and addressing potential recession fears. Buckle up. The coming months will be interesting.
We want to know your take. How should the Fed react to the ever-changing economic landscape?
Share your thoughts in the comments. That's where the real conversation begins.
Thank you for joining us as we explored expert predictions about an impending financial storm.
Lance Roberts and Tom Lee both highlighted the likelihood of corrections, but had differing views on how severe they might be.
Exactly. And while Jake Boyle is optimistic about Bitcoin responding positively to political changes, David Rosenberg raised valid concerns about Fed policies.
It's a mixed bag indeed. But one thing is clear, staying informed is key to navigating these turbulent times.
If you found this discussion valuable, don't forget to like and subscribe to our channel for more insights.
And while you're here, check out our other videos that delve deeper into economic trends and investment strategies.
See you next time, and remember to stay savvy with your investments.